Welcome to this week's edition of Northwest Quadrant Wealth Management's e-news. Thanks for joining us as always. Well, it's become increasingly clear, I think, to both of us over the course of client meetings over the last couple of weeks, at least since we recorded our last video, that there's this real sort of bifurcation between news flow and client perceptions of reality. And a lot of questions are arising about, just why are stocks vaulting to new highs, and why is the market breaking out to a new all-time high amidst what many people perceive to be a largely negative news flow. And here we are in a week where earnings season's pretty much wrapped up. Earnings growth and for the S&P 500 at least, nothing short of astonishing. 28% year on year, almost every company beating. You hear the hyperscalers, which is really those big technology companies, communication service companies that everyone is familiar with, the Amazons of the world, are spending $750 billion in CapEx over the next year. Those estimates are likely to be revised higher. And, when you see what's happening in the market, the free cash flow of all of these large technology businesses is being eaten up on expenditure in real world infrastructure. And it's hard for us to, sort of really communicate the scale of what that means, but you kind of see it represented in the stock prices of physical real world things like transport stocks like JB Hunt, or industrial equipment stocks like Caterpillar, where there's really just an absolute unprecedented level of demand for the things that they're making. So those earnings are flowing from those technology businesses down the capitalization spectrum and towards real world things like materials and industrials. And you're sort of seeing that borne out in stock prices. But the real sort of dilemma for people out there is understanding and divorcing their political affiliation with, the actual reality on the ground, which is this build out, this AI build out, is just absolutely unprecedented in scale, and it's flowing to all of these businesses that make tangible things. And it's very different from the earnings that were being created sort of in the wake of COVID, which largely centered on virtual businesses and didn't result in actual creation of physical infrastructure that we're seeing today. And we think that that sort of explains, remember, markets are forward looking. And so they're pricing in a reality a year from now. And they don't, the market has already looked through the Iran war, despite, we would also tell you sort of to be aware that volatility and, in the upcoming couple quarters is very likely, as some of these things are left unresolved.
Yeah, so the other obviously issue that's going on right now is we just got the wholesale inflation print yesterday, where we saw inflation up 6% year over year last month. Obviously, the situation in Iran, the inflationary pressures are starting to mount here in the U.S., and so that's going to play a role in the new Federal Reserve Chairman Kevin Warsh's situation, in that the Fed is most likely not going to be able to cut rates anytime in 2026. In fact, historically, if you saw inflation prints like we're getting right now, and on the employment rate where it is, you would be hiking rates. And so the bond market is pricing in a higher percentage that the Fed hikes rates than cuts rates. We don't think either of those things is going to happen. I think the Fed will just mostly likely stand pat. But there's the bond market, and the bond market is pricing in higher inflation for longer, which means longer interest rates on the long end of the yield curve. We just had a bond auction last week, where we had the first 30-year bond come out with a north of 5% coupon. That's the first time that's happened since 2007, almost 20 years. And so I think the ultimate story there is we're going to have longer rates, or higher rates on the long end of the yield curve, which at some point rates keep going higher at the long end of the yield curve. That's competition for stocks. And so one of the messages we wanted to get out there is, we should expect some volatility in the equity markets. Forgetting the situation in Iran, there's so many other things that could cause volatility. Just straight stocks going up as much as they have in a relatively short period of time, they're due for a breather. And remember, those breathers, those sell-offs are healthy for markets over the long term. So if we do get one of those sell-offs because of higher rates or because something happens in Iran, we don't want you to be scared and shaken out of markets. You should expect it, and in some cases welcome those sell-offs, because they take sort of some of the steam out of the engine, so to speak. So as always, if you have questions about your situation or your account, call us at the office, 800-743-0988, or you can email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.